Welcome to another edition of Global Tax Talk. I'm Berber. I'm joined by my co-host, Cortvriend in Belgium. Welcome, Ellen. Many companies are focused on income or direct taxes due to the potentially significant impact of Pillar 2. Today, we would like to turn our attention to indirect taxes such as VAT, GST, and other consumption-based taxes. Ellen, what indirect tax developments and trends are top of mind for companies today?
Thanks for the question. Indeed, there are a good couple of trends to mention that clearly have an impact to indirect tax professionals nowadays, and that put an additional focus spotlight on indirect taxes. First of all, we see an increased number of indirect tax-based regimes being introduced in many countries around the globe. Because for governments, it is typically easier, it's typically cheaper to implement these types of systems over and above, for instance, the increase of direct tax rates, whilst, of course, still achieving their ambition to increase the overall revenue for their country. A good example of this recently would be the introduction of a VAT-based regime for Brazil, which means a complete overhaul of their current local, state, and federal indirect tax system. We also see the same trend, for instance, in Malaysia, where it is the ambition to move away from the current service tax regime to a more general GST-based regime in the near future. A third one is as well that you can see that indirect tax systems are more and more being used in order to tax the evolving business models. Think about the platform economy. A good example of this would be Japan, who has implemented as part of their overall tax reform a consumption tax on the inbound services that are being provided to consumers in Japan over a platform. The second trend that is important to consider is everything that governments are doing in order to close the so-called VAT gap. What is the VAT gap? It is the difference between what a government should obtain in terms of VAT revenues and what they actually achieve to collect. And if you were following some studies that are, for instance, performed on an annual basis by the European Commission, you can see that this amount, the VAT gap, is really huge. For Europe alone, not if you start looking beyond Europe, it's really a huge amount of money, where, of course, this also influences the number of territories that are looking into measures to come to a better collection of the VAT. Good examples of this would be the introduction of electronic invoicing, for instance, mandatory electronic invoicing, which is popping up in a number of EU, non-EU countries nowadays, and where there's even an initiative on European level, the so-called VAT in the Digital Age initiative, whereby it is the intention to implement a digital reporting requirement, moving away from the aggregated type of reporting to a real-time reporting mechanism in relation to the cross-border transactions, but with the intention, the ambition to potentially also implement this for domestic transactions. You also see many countries, good examples would be France, would be Belgium, would be Spain, would be Germany, would be Poland, all moving into mandatory B2B e-invoicing in the very near future. You also see that there are new and additional reporting initiatives, for instance, on payment information. Think about the introduction of CESOP. So those are already two very important trends, I think, that are important for businesses to consider nowadays.
Thanks, Ellen. Staying compliant with indirect tax requirements can be challenging and is oftentimes a business imperative, given the significant numbers at issue. At the same time, companies also want to strengthen their agility so that they are prepared for more changes on the horizon. Will Morris, PwC's Global Tax Policy Leader, recently sat down with Christoph Zenner, PwC's Global Indirect Tax Leader, to discuss how companies are keeping pace. Here's an excerpt of their discussion.
Since tax schemes are really quite stretched, the regulatory changes, the legislative changes can come frequently and are actually quite difficult to embed into ERPs, into companies' collection systems and the technology. So how do you see clients keeping pace? How can clients keep pace with this?
It goes a bit hand in hand with the previous question,
right,
of course, because technology is one of those elements to review. And so how to keep pace? Indeed, it's an increasing number of requirements coming towards a tax department. And so it means well, reviewing how are we organized and what are we going to do.
Right.
Now, on the positive side of things, we could say it is a driver for change. It puts things also on the radar, and it gives, well, if anything, a platform or a momentum to a tax department, to an indirect tax department or team or function to review their function and to address that and to bring that to the company's agenda in terms of how do we want to go by with technology. We cannot afford to do nothing, or how are we going to fill in the processes aspect? What are we going to do? Centralized, decentralized, in-house or not? So all of those things, it's really a driver for change and consideration, and gives a proper point in time to review one's strategy and to bring that to the broader corporate agenda.
Right, and also, I mean, to the point that you were making before about there are changes in the direct tax world, changes in the indirect tax world. Sometimes these two taxes can overlap, DSTs, for example. Actually making sure that there's a whole of tax department approach to this as well.
To listen to Will and Christoph's entire discussion about the indirect tax policy landscape, please see the link in the description of this video. Ellen, we just heard Will and Christoph briefly discuss how new VAT reporting requirements can yield momentum for tax functions to take a fresh look at their indirect tax processes, such as whether they should be centralized or decentralized, and how technology can help bridge the gaps. How are companies rethinking their indirect tax ecosystem? What are some examples of actions companies can consider?
Well, I think the first one, which may sound like a very obvious one, is for businesses to really have good visibility on their upcoming roadmap of requirements. It may sound like an easy one, but given the fact that each and every country is implementing its own very specific model with all the rules around it, this is already something which is quite burdensome for businesses. But for me, it is really a crucial step to have good visibility on your upcoming roadmap of requirements to make sure that you can indeed have this available as a first step in implementing an overall global e-requirement strategy. When talking about that strategy, you can see that there is really a clear shift going on as we speak, which is of course driven by the pace at which new requirements are popping up, with companies moving away from the local approach they have been taken, which made sense for many years, where there were only a few e-invoicing or reporting applications, to a more global, a more holistic strategy in terms of the technology they're using, in terms of the processes they're implementing, to make sure that they can not only deal with the requirements that are already hitting them today, but to make sure that they can also do so for every requirement that is hitting them in the future, without having to start up a project per requirement that is popping up, but where they come to a situation where they can really leverage from the experience of implementing the previous set of requirements before. I think the third element that I want to bring is, of course, also the data aspect and impact that these requirements will have to businesses. Businesses should start working around their data, the quality of their data, because with real-time reporting, with e-invoicing, governments nowadays have in real-time visibility to your transactions as and if they're happening, meaning that also from a reporting point of view, this set of data really becomes the source of truth for your period end reporting. So you need to be, as a business, very sure about the position you're showing in terms of the transactional data you're reporting, but also how that data set is aligning with the wider set of reportings you need to perform as a business. As an example, what if governments in the future start comparing my real-time reporting from an indirect tax perspective with, for instance, a position I'm showing in my local forms for TP purposes? And that is only one example. Am I comfortable about what I'm showing to a government? And then, of course, it's also a matter of, as a business, making sure that you can reconcile all the information that you report in real time towards the government with those period end reportings, to make sure that you handle, that you tackle the differences that you spot, because that is, of course, also the shift that governments will take, where they really will start focusing during audits on the differences they spot between the various reportings that need to happen. So making sure that as a company you're also prepared for that in case of audits is of course a very crucial one.
Thank you for sharing your perspectives. For more information, be sure to listen to Will Morris every week for 60 seconds on key global tax policy insights for the coming week. We'll be back soon with another episode of Global Tax Talk. Thanks for tuning in so you can stay global tax ready.